Good morning, everyone. Welcome to the Gelman, Rosenberg, and Freedman webinar series. My name is John Pace, and I will be moderating this morning's webinar, as well as presenting the valuation portion. I am a partner with the firm and have been working in the accounting and finance area since 2005. This morning, we're going to be discussing exit planning, preparing for the end from the beginning. Our goal today is to give you an introduction to some of the major concepts supporting a proactive approach to exit planning. We believe that preparing in advance will help create a smooth transition and will help maximize the value of your business. So before we get started this morning, a few housekeeping notes. We want to let you know that this webinar will be recorded and made available after the event for future use. If you're experiencing any technical difficulties, please note the chat function that's displayed in the right side of your screen typically, and that will help you troubleshoot any technical issues that you may be having. If you're having severe technical issues, you can also call WebEx at the toll-free number shown on the screen. There will be an approximately 10-minute question and answer period at the end of the presentation as well. And for those folks that are seeking CPE credit, please note that there will be a short survey at the end of the presentation that you will be required to fill out and submit in order to receive CPE credit. And additionally, as part of providing CPE, we will be providing 3 code words during the webinar, which you will also be required to submit on your survey form in order to receive the CPE credit. So we're not allowed to repeat those words, so make sure you make note of those CPE code words. And as you get to the end of the presentations, please make sure to disable any pop-up blockers, as those might actually block the survey. And the presentation slides are going to be available for download at the link on the bottom of slide 3, which you're seeing on your screen right now. Okay. So let's jump into today's speakers. Presenting today's webinar are GRF partner Walter Dial and GRF partner John Pace, that's me. Both of us assist many GRF clients in the area of exit planning and business valuation. Walter has over 30 years of tax, business valuation, exit planning, and accounting experience and works with many different types of organizations. I have over 19 years of accounting and finance experience and also work with many different types of organizations that are GRF clients. So at this point in the presentation, I'm going to turn the presentation over to Walter, and he will get us started this morning.
Thanks, John. And thank you all for joining us this morning. As John mentioned, I've been working with business owners for over 30 years. Business owners are a very interesting and exciting group to work with. Couldn't have picked a better career than working with business owners. They're generally very smart, resourceful, good leaders, and they're also risk takers that oftentimes take action based on instincts. And all of these traits can be great in creating a valuable business, and for lots of our clients, that's exactly what they've done. But our goal in introducing formal exit planning to our services is to help the business owners realize full value for all their hard work and hours spent building their businesses. Unfortunately, as we'll be discussing, without proper planning, many business owners will not be in a position to reap the maximum benefits from all of their labor. So let's start with a definition of exit planning. So exit planning provides, we look at as providing a roadmap that allows business owners to transfer their business, and we really focus on 3 things: transferring their business when they want, for the amount of money that they want, and to the person that they choose. It's important to note that these 3 goals really will come at the expense of other goals. So for instance, you may want to retire at 60, so that's the when you want to retire. But if you're already 59, you may not have as many options as to who you're going to be able to sell your business to, and you're certainly not going to have as much time to increase the value of your business, which will affect the amount of money that you're going to get. So it's important to keep in mind that each of these goals are interdependent upon each other. When you're looking at exit planning, there's a financial cost associated with it. and there's certainly a time cost associated with it. So there has to be, enough benefits to warrant putting that effort into it. So let's take a look before we really dive in at some of the benefits that we believe you can derive from exit planning. So the first one would be maximizing the value of your business. And what we mean by this is, if you think about valuing businesses just in a very fundamental way, most businesses sell for a multiple of earnings. So let's say that your business is in an industry where businesses will sell for anywhere from 3 to 7 times earnings. If your business is currently has the characteristics of businesses that are selling for 4 times earnings, if through the exit planning process we can change your business in a way that increases your multiple from 4 to 7, and your business is generating, let's say, $1 million of revenue a year, that's going to increase the value of your business by $3 million. So through proper exit planning, you can really make a huge impact on your ability to retire successfully. And that's just one example. And we're going to discuss some steps we can take to help you grow the value of your business later in the presentation. Another benefit of exit planning is it minimizes risk, and it does that in a couple ways. One is through the analysis of how much you need to successfully retire versus the assets that you have on hand. We may identify a gap, which means there may be a need, an immediate need for insurance to protect your family in case something happens to the business owner or the business itself. Taxes are always a risk factor just because there's ways to reduce them, and many people don't take advantage of that, and the exit planning process helps to identify some of those methods. And then another issue is proper exit planning helps you stay in control of your business. So, without proper exit planning, you could be in a situation where something happens to your health, and all of a sudden you're in a position where you have to sell your company. So you're really no longer in control at that point. You could also be in a situation where you're dependent upon one large customer for your business, or you're dependent upon 1 or 2 key employees for your business. It may seem that you're in control as long as the employees are there and the customer is there, but in a sense, your control is tenuous at best, because should those key employees leave or something happen to that customer, all of a sudden you're no longer going to be in control and you may be forced to sell your business. Interesting story about what can happen with proper exit planning and what can happen sometimes when there isn't proper exit planning. We had a client who we picked up, I guess, about 3 years ago, and they came to us. They had been in business about 50 years, pretty successful, and they came to us shortly after the father of the family, who had owned the business 100%, he had passed away. And he thought he had done exit planning in the sense that in his will, he left his company to his 4 children, 25% each. His 2 sons were active in the business. One was pretty much running it, and the other was in sales, and the 2 daughters were not involved in the business in any way. So what happened shortly thereafter was the one son assumed control of the business, the other one assumed control of the sales force. Within 1 year, the son who was running the business was put in a position of having to fire his brother. The 2 sisters are constantly complaining about the lack of dividends from the business, and they've taken actions as shareholders to limit the amount of compensation that the brother who's running the business can take. Lawyers are involved. They no longer, share Thanksgiving dinner together and things like that. So it's just really a sad situation. And really, when you think that the father probably thought he was doing a great thing, he was leaving the business to the kids. In his mind, fairness dictated that he leave 25% to each. He made no provisions for voting shares, no provisions for anything, really. So what he had hoped to be like a blessing to his family really ended up to be a curse. Then we have another situation where a current client, very successful business again, he's in his early 60s. He has 2 children who work in the business. They're not really key employees, but they are important to the business. So he decided that he wanted to sell the business. He wanted his kids to stay involved, and they wanted to stay involved. So the 2 children plus 2 other key employees are purchasing the business from our business owner. And it's really worked out well so far. We had to bring in a business consultant to help to train the next generation on how to run a business. They were each good at their specific aspects of the business, but they had never really run a complete business before, so that's been helpful. And the owner's being paid out over time through the cash flow from the business. So we're able to minimize his taxes that way. He's able to maintain control in that way. And it's only been about 1.5 years in so far, but it really seems to be working out really, really well. So with proper planning, a lot of your exit planning goals really can be accomplished. PwC did an interesting study where they did a survey of business owners 1 year after they had sold their business, and 75% of them were dissatisfied with the results of their exit planning, or they had done no exit planning. And it was interesting that only a fairly small percentage of those was dissatisfied with the amount of money they had. It was really a matter of either the business was not being run the way they hoped it would be, or they had just failed to really plan for this next stage in their life. So it's it really kind of helped to drive home the need for exit planning. So before we really dive in, let's go ahead and do our polling question.
Great. Thanks, Walter. So our first polling question of the day is quite simple, right to the point. Are you the owner of a business? And while we give you several seconds to go ahead and answer that question, we're going to give you the first CPE code word of the day. And that first CPE code word of the day is vacation. Again, that's vacation in honor of the upcoming 4th of July weekend. So we're going to give the poll a few more seconds, and it looks like basically that we have a pretty even split. We have a handful of, certainly a big bunch of business owners. Some of you are planning on becoming business owners, so that's exciting. So that's great. So at this point, we'll kick the presentation back over to Walter to continue.
Okay, let's take a look at how the exit planning process begins. So we start with what we call the 3 universal exit planning questions. The first one is, how much do you need from the sale of your business? The second is, when do you want to exit? And the third is, to whom do you want to transfer the business? So you can see these are really, they're questions, but they're also really the goals of exit planning. And again, like I mentioned in our definition, all 3 are interrelated. The answer to each question is going to impact the answer to the others. So for instance, if you need to get every cent possible out of the sale of your business, then you may not be able to transfer it to family or to insiders, because generally speaking, that's usually going to be your least profitable way to exit your business. If you don't want to exit for another 5 years, then when it comes to how much you need from the sale of your business, you have plenty of time to implement steps to drive the value of your business up. So it's important to note that these questions are all interrelated. Another important thing to note is question number 1 requires a very concrete answer, whereas questions number 2 and 3 oftentimes are a little bit more iffy. So I have a lot of clients who I'll do an initial meeting and ask them, when do you want to exit your business? And the answer will oftentimes be, well, I'd like to start slowing down at 63. If I could be out by 65, that'd be great. But if I have to hang around for a couple of years, that's fine too. Or when it comes to transferring the business, oftentimes, they may have a key employee group, or they may have family members, and if it can be done, that would be their preference. But if it doesn't, if it's going to take too much work, or it's just going to be a little too complicated, they're okay not transferring it to insiders. So how much you need for your business requires a very concrete answer. The other 2 can be more flexible. So let's kind of look at how we start to develop the exit plan. So we start with those 3 universal questions, because the idea of the plan is it's all centered around the goals of the business owner. It's the business owner is at the center of the plan. That's just the way it has to be. So we start with the 3 universal questions to begin with, and then people have other goals, personal and financial. So they may want to give money to charity. So it may be a matter of setting up a private foundation with the proceeds of their company. They may be very concerned that the culture of their company continues, or that their current employees continue to have jobs. That's going to dictate who they sell their business to. They may not be able to sell to a third party, because in that situation, there's really no guarantee that the company's going to be run the way the way you want it run, or that even the employees are going to stay on board. So there can be lots of different financial and just personal goals that need to be considered as we're developing the plan. Now remember, I mentioned that question number 1 about how much money do you need really requires a concrete answer. So let's take a look at some of the important points with regard to the personal financial modeling. So determining how much you need. It's really, when you think about it, it's really pretty simple. It's a matter of determining the value of the assets that you currently own. Then it's a matter of projecting out what your expenses are going to be in retirement, and then doing some financial modeling to see if the assets that you have are going to provide the income that you need for a successful retirement. But of course, nothing is really that simple. So if we go back to point 1, putting together the value of all existing assets, we need to make sure that the value of the business is properly considered in this. So for many business owners, the value of their business can constitute as much as 90% of their net worth. So it's critical that the value of the business is estimated realistically and properly for this purpose. So we're not, and John's going to talk about this more later in the valuation section, we're not suggesting that you get a full-blown, expensive, and time-consuming business valuation, but you do need a real professional business valuation, and John will explain the differences, the different steps that we can take. The worst thing you can do is figure that your business is worth X because when you were in the country club locker room, one of your friends said, "Oh, I just sold my business for 5 times earnings." And of course, you figure your business is much more valuable than his, so yours probably will sell for 8 times earnings. Well, every business is unique. Every industry is unique, really. So you really cannot afford at this stage to be basing your exit plan, even if you don't have an exit plan, but just some thought in your mind as to how much you need. You cannot base that on just some rule of thumb or something that basically you have made up. You really need to get a valuation done at this point. When it comes to projecting your expenses, the key here is to be realistic. The worst case scenario for anybody in retirement is that they run out of money. So you really need to project your expenses realistically, and I would say aggressively, meaning plan for the worst. So a couple things that many times people don't think of as they're planning out their expenses. One is, if you're a business owner, a lot of your expenses right now may be paid by the business. So for instance, you may have a car that's provided by the business. You may have country club dues that are provided by the business, various travel and entertainment, health, life insurance, disability, your cell phone probably. You may have a home office. They're providing internet. There's a whole myriad of expenses that businesses can legitimately provide to their owners. So you need to make sure that you consider the fact that once you've left the business, you're going to be paying for these expenses on your own. Another point to consider when you're looking at expenses is, there was a rule of thumb, I'm not sure if it's even still out there or not, but it used to be, well, consider your retirement expenses to be 75% of what your expenses are now, with the thought that you don't have to buy as much clothing and you may not be commuting to and from work, things like that. And, maybe that's, I don't think that was really ever a good rule of thumb, but maybe it would be for your basic employee type person. But for a business owner, our experience is that expenses, at least in the first 5 years, tend to be higher, not lower, than they have been traditionally. Part of it is for the reasons I already discussed, that they're paying more of their own expenses, but also, for many business owners, they've made a lot of sacrifices over the years to get their business to where it is. They're working very long hours, they're deferring vacations and other trips. So when they do retire, they would really like to start enjoying, the fruits of their labor. So we see a lot more travel going on the first 5 to 10 years. A lot of different, just enjoyable activities that cost money. So it's really important that you factor all those in when you're looking at your expenses. And then when it comes to the financial analysis, we run what's called a Monte Carlo simulation, which is really, really pretty cool. What it does is it takes the value of your assets, and then it takes the projected expenses, and we give it a model portfolio for the investment of your assets, and then The Monte Carlo simulation takes the investment return of every class of asset going back to pre-1929, and it does either 5 or 10,000 tests, random samples, where it just pumps in, all the different returns randomly, and it comes up with a probability of you successfully retiring, which means that you die and you still have some money in your bank account. Our goal is to get like a 97% success rate, but it may turn out that the Monte Carlo simulation comes back and it says your chances of success are 75% or 60%, in which case some changes need to be made. Or it may come back and say you've got a 98% or 100% chance of success, in which case that's great and you're all set. But what we need to look at really is, what if the analysis comes back and it shows that based on current assets and the projection of expenses currently, there's a gap. You don't have the amount of assets that you actually need to make that work for you. So at that point, what we do is we call it a gap analysis. And if there's a gap, there's really two areas that we need to look at. One is we need to look at, is there anything we need to do immediately? So for instance, if there's a substantial gap and there's not life insurance in place, that's probably a step that needs to be taken. We're going to have to go out and get the business owner will have to get some life insurance, because if he doesn't have the assets counting the value of the business, if he dies, the value of the business is going to go down, since he's done no exit planning up to now. So there's going to have to be some insurance to provide for his family. Now, of course, in doing that analysis, the level of expenses may be able to be adjusted, since we're looking at one person instead of two and things like that. But that's one immediate need we would take a look at. And then the next thing would be, if there is a gap, one way to bridge that gap is by growing the value of the business. And when we talk about the value of the business, we're talking about the net after-tax proceeds. So really, increasing the amount of money that you're going to get from the sale of your business really entails at least two things. One is growing the real intrinsic value of the business, and the other is just putting into plan the most tax-efficient strategies we can to reduce the taxes, so that we're increasing the net after-tax proceeds. And we're going to take a look more in detail, especially with the growing value aspect of this. One thing I like to say before we leave the slide regarding the gap analysis is, I understand, and I've been with clients who we've done this gap analysis and they've come up short, and it can be, depressing or surprising, shocking. I'm not sure what the best word would be. It's different in every situation. But, I try to look at it with a more positive attitude, in that knowing there's a gap is really very powerful. It gives you power now to put steps into place to bridge the gap. And we're certainly here to help you. That's our main role in this. But knowing that there's a gap is a lot better than finding that out when you decide you're going to sell your business a couple months from now, and wow, there's this gap. You can't sell your business because you need the income for the rest of your life. You're stuck, or whatever those consequences are. So I would look at it as, yeah, it's too bad that you didn't have exactly what you thought you had, but be empowered to know that, as long as you have enough time, you can change it. You can bridge that gap, and you're going to have a much stronger company as a result of that. So, I kind of look at it as good and bad, I guess. So let's take a look at the growing value and reducing tax aspect of bridging the gap. We'll start with the tax aspect. That's a little simpler. And there's many tax saving strategies we can employ, especially when selling a business. There's a lot of good strategies, but they would require, each one probably would require its own webinar. So I just kind of highlighted three kind of simple ones. One is the installment sale. I kind of hit upon that earlier, but if you receive a lump sum of money in 1 year, chances are that's going to drive you into the top tax bracket. So marginally, you're going to be paying the most possible taxes that way. If instead you do an installment sale where you are receiving money over time, you may be able to keep your bracket lower, which is going to reduce the overall taxes on the sale. Now, there are some concerns with installment sales. You're almost always better from a security standpoint getting your money up front, of course. But in the right situations, an installment sale can definitely help reduce taxes. ESOPs, which are employee stock ownership plans, we're not going to discuss those because they're very complicated, and they really apply to, you really have to have a company that fits the mold to do an ESOP. They don't work, I would say, in more than 75 or 80% of the companies. But if they do work, and we always do that analysis, they are unbelievable. I mean, to the point where you can literally pay no tax on the sale of your business. It really is amazing. And then donor advised funds, that's just kind of another easy one. But if someone has charitable intent, a great thing to do if they're going to get a whole bunch of money from selling their business in 1 year, they could also make a very large charitable contribution to a donor advised fund in that same year. So they're going to match their deduction to their income. But the advantage of the donor advised fund is that while you get your deduction all in that first year, you then get to give the money to charities over many years. It's kind of like your own little private foundation without having to go through all the cost and headache of establishing a private foundation. So growing the value of the business is certainly the more interesting and exciting aspect of bridging the gap. And again, it goes back when we talked about how the three universal questions and the goals, they're all interrelated. The more time you have between now and when you're going to sell, the greater opportunities you have to grow the value of your business. Because things you're going to do to grow the value of your business, I mean, some of them can happen very quickly, like within 6 months, but many of them are going to take a year, 2 years, 3 years. So we always, the perfect exit planning situation is a client who is 3 to 5 years out from selling their business. Because if there is a gap situation and we need to put steps in place to grow the value, that's really the perfect timing to do that. So I've just highlighted, John and I work with a lot of closely held businesses, and these are just kind of the typical challenges we see in them. And what it usually comes down to is, they're small businesses. The owner usually has his hand in everything. He is the center, the hub of the business. Everything runs through him. And he's happy with that because he's got control and he's been successful that way. The problem is when outsiders come and look at your business, they don't see that as an asset. They see that as a challenge. So that can be described as lack of a management team, too much personal goodwill. The value of the business is wrapped up in the owner. And oftentimes small businesses rely on 1 or 2 big clients. You lose one of those clients and all of a sudden your business is not nearly as valuable as it was. So the good thing is there are solutions for each of the challenges. We've done some really creative things with incentive compensation. And the idea there is you take your management team and you try to start treating them like owners. So they start to feel like they have an ownership stake in the company. And incentive compensation can even include stock options, incentive stock. It can include restricted stock or just outright shares of stock. So that can certainly be a component of incentive compensation. But it doesn't have to be. You can also just do cash bonuses that are rewarding members of your team for doing things that grow the value of the company. So it's a really cool situation where we sit down with an owner and we come up with some plans to grow the value of the business, and then we incentivize the employees to do that. It's just a win-win all the way around because the value of the business is growing. The employees are getting extra compensation for that. They're beginning to feel like owners. Everything is just moving in the right direction in a situation like that. For the too much personal goodwill challenge, I mean, that's a tough one because it really comes down to giving up control, and many business owners are control freaks. So it can be tough, but when a business owner sees that his lack of delegation is really going to cost him a lot of money at the end, that can oftentimes be enough motivation to get them to start doing the right thing as far as building up a good, strong management team and delegating responsibilities to them. Customer concentration, oftentimes the business is going great with their 1 or 2 customers, and they're so busy they just haven't really focused on getting other customers, but that needs to become a focus in many situations, and that can be done through sales training. It may be doing targeted acquisitions of other companies. There's lots of different things you can do in that situation as well. Let's go ahead and do another polling question before we start talking about transfer options.
Great, thanks, Walter. So our second polling question of the day is, do you plan on exiting your business in the next 5 years? And while we give you some time to answer that polling question, let's go ahead and do our second CPE code word of the day. And that code word, keeping with the theme, is fireworks. So again, that code word for CPE credit is fireworks. And we're going to go ahead and keep the poll open for a couple more seconds. And then we'll move on. Okay, great. Great, so we're going to go ahead and close the poll now. I do not actually see the results of the poll, so we're just going to go ahead and move the presentation back over to Walter, and we'll continue.
Okay, thanks, John. Let's take a look at 4 basic transfer options. And the goal here is really just to do an overview. You know, there's a lot of intricacies in each of these, and each one is different depending on the parties, but we can look at some of the basic benefits and challenges associated with each. So your 4 basic choices in transferring a business are transferring it to insiders. That would be like your key management group. You could transfer it to family members who may or may not be in the business. Hopefully they are in the business. Sale to an ESOP, which again we're not really going to discuss, or sale to an outside third party. So that could be a venture capitalist, it could be a competitor, it could just be someone who is looking to buy a business and run it. So let's go ahead and take a look at those in a little more detail. So for the inside sale, and again, this is your sale to your key management group. There's definite benefits and there's definite challenges. The good news is the challenges can be overcome, but let's take a look at the benefits. The really great thing is it could be your successor of choice. I mean, you may have a business that you started from the ground up. You've got employees who have been with you for over 20 years. Some of them are just really chomping at the bit to kind of take over. They've been loyal to you. They're almost like family. And there's nothing you would want more than to transfer the business to them, to give them the opportunity to keep it going. The culture is going to stay the way you like it. Customers are going to be happy. If you're in a certain location that you like, chances are it's going to stay there. So there's a lot of benefits to doing an insider sale from that standpoint. So I look at that more from the emotional or non-financial standpoint. The insider sale really has pretty much all the benefits. You can continue to maintain some measure of control through an inside sale. So you don't necessarily have to sell all the company. You could sell a portion. You could sell non-voting shares. You could do one of these situations where you gradually fade away, that type of thing. One issue is, if you're selling the company, you do have to come to grips with the fact that you do have to give up control at some point. So while this will let you do it gradually, it does have to happen. So, you can achieve a lot of values-based goals, kind of like I've been discussing. A lot of the non-financial goals, you can really achieve those through an inside sale. But as I said, there are challenges with the inside sale. The number one challenge is no money. And what we mean by that is, chances are insiders are not going to have a ton of money. They're not venture capitalists who can just come and write you a check. Just like the rest of us, they may have families who they're put through college and housing, mortgage payments and things like that. They don't have a lot of money just laying around, and they may not even be able to borrow a whole lot of money. So, probably what's going to happen in that situation, number one, you may not get full value, but you're going to go in with your eyes open, realizing that you're not going to get full value, and you're okay with that. And then you're going to get paid out over time. So hopefully they can borrow enough to get you a chunk of change immediately, and then they'll pay you over. I've done some that are like 3-year payouts. We were doing one that's an 8-year payout, which is pretty long. Really wouldn't normally do that. And you're going to get paid out over time as they realize cash flow from the business. So, you're dependent upon them to continue to run the business well, but you wouldn't be selling it to them unless you were pretty confident that they could do that. there are ways, we can minimize the tax consequences of the transaction. So even though you're not getting full value, maybe on an after-tax basis, you're getting closer to full value than you started, so that's good. We can issue non-voting shares so that you get to maintain control until you're fully paid. That's something we pretty much do every time. And as I mentioned before, it can be incremental. They can gradually purchase stock, and you can even make one we've done where we had the initial plan was for a 10% transfer of stock to the insider group, and then as long as the company met certain financial goals, they were allowed to continue buying stock. But if the company didn't meet the goals, they were not allowed to continue buying the stock. So that was a way to really incentivize them to keep the company going successfully, which is another way to make sure that you're going to get your money at the end of the day. So that's the inside sale. A lot of benefits, especially on the soft side, some challenges financially, but if you have the time to make it work and you have the good employee group and you've got enough assets that you can afford to take a little bit less than full value, we can definitely make an inside sale work. And inside sale is similar to family, so I didn't separate those in this case. It's pretty much the same benefits and the same challenges. The only thing I would say in that regard is if you want to transfer to family, you really need to be careful if you have some family that's in the business and some that's out. And like that client I mentioned, he thought the fair thing was to give 25% to everybody, even though his two daughters were not in the business. That turned out to be a mistake. There's ways to compensate children who aren't in the business other than giving them interest in the business, which may work better. But the important thing is just communication. Number one, you need to make sure that whoever you want to leave the business to really wants it. Sometimes they don't, but they really don't know how to tell you that. So it really just comes down, you really just have to have a lot of communication and a plan in place that everybody knows well before the business has been transferred and everyone's in agreement. So third-party sale is kind of the opposite of the inside sale as far as benefits and challenges. So the benefits is it's going to happen fast. You could potentially get all your money at closing, and you're probably going to get the maximum price. So if you think of it, if you sell to a competitor, for instance, they may pay you a premium to get into your market or get your clients or get into your niche. Venture capitalists may come in, and if the business is really clean, really ready to be sold, you could get a really good price. And in both of those situations, you very likely could get paid out completely at closing. The challenges, of course, are the opposite from the insider sale. Now you've got a situation where you've sold. You have no control now. You're gone. So despite whatever they may tell you when they're courting you to buy your business, they can do whatever they want to with it once they own it. And a good friend who him and a friend of his had started and built a very successful business, probably 30 years, decided to sell to a third party. They were very concerned that the culture would stay in place, and they really thought they'd done a good job of interviewing these people and making sure they were going to do that. Sold the company to a venture capitalist whose goal, unbeknownst to them, was simply to reduce expenses, to increase net profit, and flip it as fast as they could. And the reputation of the business, which had been stellar, really just got destroyed, and ended up backfiring anyway. The venture capitalist 10 years later still owns the business because they did such a poor job. But it was very, very painful for the owners, very, very painful. Something else we're seeing more nowadays is earnouts when you sell your company. So what that basically means is, the economy's gotten a little better recently, but it's had its challenges over the past few years. So oftentimes, owners are going to want to sell their company based on what they're projecting the future to be, while buyers are going to want to sell based on history. So oftentimes, a compromise is reached out where there's a guaranteed price based on history, usually history plus a little bit. And then if the business does meet certain financial goals over the next 3 to 5 years, the seller will get some increased payout in the form of earnouts. And those can get complicated. The devil's in the details. You got to really be careful how you define what the earnouts are based on, and make sure you have sufficient access to records to make sure that everyone's being honest. So That's a situation where you really need a good attorney who's very well versed in that type of transaction. The other thing, last thing I'll say about third-party sale is if you go this route, your business has to be ready for sale because the people you're dealing with most likely are experts in buying businesses. So if you're not an expert in selling a business, which you're not, so if you're not represented by someone who's an expert in selling businesses, you're good likelihood you'll get taken to the cleaners, or at least the initial value that they propose is going to get nickel and dime down in the due diligence. So if you're going to go this route, you really need to make sure your business is pristine from all systems aspects and legal aspects and accounting aspects. So that's those are basically the options. Now, as I said, our goal there was really just to do an overview. So let's kind of wrap up with kind of how the plan itself would work. So if you were a business owner and you were trying to do your own exit plan, you would basically be using all or just about all of these different professionals that you see on the screen. And in my experience, if I had a task like this that was that daunting, I might start it. I probably never would. But if I did start it, it wouldn't get very far. And it's not negative on the business owner, but it's just too daunting a task for anyone to take on by themselves. So what we try to do is change the model to look more like this. So now the business owner is really only having to deal with the exit planner. Now he certainly has access to the other professionals, but he doesn't need to be worried about what they're doing. That's the exit planner's job. So as the exit planner, it's our job to task the professionals with what they need to do and then make sure that they're, hold them accountable, make sure they're doing it on budget and in a timely fashion. And then we, bring any issues to the business owner, we discuss it with them as we refine the plan. So, it's a very, even this can seem daunting. I fully understand that. But, we really feel very strongly, and after working with clients for so many years and seeing clients who've been successful and some clients who haven't, that some form of an exit plan, be it, the full-blown, really great roadmap, down to really, at a minimum, we really strongly suggest that you get the base business valuation done and a financial needs analysis. So at least you have a realistic understanding of where you stand. And then if you decide that you want to move forward in certain aspects, maybe just to grow the value of the business or tax planning, we're there to help you with that. We really feel it can be, the cost-benefit analysis potentially could be through the roof. So we would just encourage you to think about that. And, we can certainly provide you with any resources you need. Every circle you see represented there, we have great relationships with each of these professionals, but we're certainly happy to work with any professionals you have. Even if you have a CPA you love, we're perfectly happy to work with the existing CPA. If you have a CPA who you like, but maybe he's not really sophisticated in this area, we would just come alongside them. We wouldn't, we wouldn't demand that we replace them or anything like that. So that kind of wraps up my section of the presentation. I thank you for being with us this morning, and I'm happy to answer any questions. Let's do one more polling question, and then John will take it from there.
Great. Thanks, Walter. So as Walter said, we're going to jump right into the third polling question of today. Do you have a written exit plan? So quite simply, have you started this process, or is this something that you're thinking about? So I'll give you a few seconds to answer the polling question. And our final CPE code word of the day, keeping the theme and a little bit sarcastic and funny here, is the code word of the day is traffic. So hopefully this long weekend, this holiday weekend, you're not sitting in too much of it, but that's the code word, traffic. Okay, we'll keep the poll open for a couple more seconds. And it looks like of the group, we have, I think only one person has a exit plan in place. So, okay, some work to be done. Great. Excellent. Okay, so thanks, Walter, and thanks for everyone for joining us today. We're going to do, in the time that we have left, we're going to do a brief discussion of business valuation as it relates and in the context of exit planning. And so we'll jump right in here. And the first takeaway that we want to provide is that valuations for exit planning are typically different than those that are performed for other statutory reasons, such as some other type of tax issues or financial statement reasons. And one of the key differentiators there is the emphasis is not on hypothetical willing buyer and seller, which relates to a standard of value in a business valuation called a fair market value. So rather what we're looking for, instead of a fair market value, we're looking to maximize your strategic value or your synergistic value as a business owner. And so to expand on that a little bit, the basic fair market value standard says basically what we have is what we're looking for is kind of a generic transaction where you have a willing buyer and seller. And that's why the word hypothetical is used. And so that standard applies to the fair market value, standard of value, and is used in many different valuations, but in this case, we don't care about a hypothetical buyer. We care about an actual buyer. We care about targeting a purchaser directly for your business and maximizing the synergies in your business. And so that's what will get you the most money. So as Walter alluded to a little bit earlier in the presentation, we typically don't need to go all out and do a full 50, 60, 100-page business valuation in compliance with the accounting standards that are there for business valuations that are referred to in that second bullet point there as the SSVS. Those are the AICPA promulgated accounting standards that govern business valuation. So we don't need to go through all those processes there. We're looking to streamline that process, save you a little bit of money. It's not typically as expensive as a full-born valuation report. And the analysis is typically based in two main areas. The number one is really cash flow. And then the other thing that the evaluator will do is search for comparable companies that have sold in recent histories that are similar size to that of your business and try to benchmark your business against that business or those group of businesses that the evaluator has found. And so the best analogy in that situation is you can think of a real estate agent. So if you're a buyer or a seller of a home, your real estate agent is going to do an analysis of the comparable properties to either make sure you're not overpaying for your property or to make sure that that your property's priced right so it will sell fast. So the same concept kind of holds true here in this valuation context. So digging a little bit deeper into the three main approaches that we're going to take, we just touched on them briefly, but the first one, again, as we said, is cash flow based. Quite often your evaluator is going to start with historical results. So that means historical financial statements, whether you have an audit, whether you have a review or a compilation, or we're just looking at internally prepared accounting records from your accounting software. So there, depending on the situation, you might have a business that has strong historical results, but there could be a situation where maybe you've had up and down throughout the history of your business. So typically we would start looking at 3 to 5 years of historical results, and if there isn't what we would kind of call a linear trend, then we would also look at or consider forecasting the next 3 to 5 years. So maybe out of the last 5 years you've had 2 kind of down years, but then you started to turn it around. That may be a situation where we might want to at least consider a forecast. And one of the keys there, if we're going to use a forecast, is let's make sure we work together and we use realistic numbers, because as Walter mentioned earlier, an experienced business buyer is going to kind of see right through a soft forecast, if you will. Again, another major way we're going to look at valuing your business is based on market comparables. And Walter's mentioned a couple times throughout the presentation, he used the word multiples. He used it, applying a multiple to revenue, or perhaps a multiple to EBITDA. And those are terms that you may have heard when you're discussing the subject. But basically, the goal there is to take data from databases, from completed transactions, from publicly traded companies, to create some type of analysis that we can apply to your business to kind of basically get a value that we can hopefully then sanity check with a cash flow based approach. And so a couple things to note is if you're like most small businesses, the size of your business couldn't be really further from a publicly traded company. So, we kind of beware of using multiples that are derived from publicly traded companies because, in almost all situations for our clients, they're vastly more than 10 times the size of the company that we're valuing. So you have to beware when you use that data because it's really quite often just simply not apples and oranges. It can be useful as a sanity check, but you just have to make sure you understand what you're doing. And if you're a business owner and you're proactive and you're into and excited about going and finding out as much of this as possible on your own, just be careful when you look at databases or if you subscribe to databases that show historical returns of businesses. You have to be extremely careful to make sure that you read the frequently asked questions, the directions, and all the definitions of how they're determining their multiples. Most of the databases use slightly different formulas as to what they include or do not include in the multiples that they derive. So if you do not take the time to read those instructions and be well versed in that area, you could very easily apply a multiple. Again, going back to apples and oranges, you could apply an inappropriate multiple to your business and end up with the wrong result. So the final method that we'll talk about is an asset-based method for valuing your business. Basically what we're doing here is we look at your balance sheet, the assets of your company, the liabilities of your companies, and we adjust those to fair market value in order to get a value of your business. Walter and I, based on our experience, we don't think this is the best way to value a business in this context. We use this method typically to get a floor for evaluation, to kind of get a feel for where things are going. But almost typically, I know everyone's heard the phrase "cash is king," so that really holds true here. A buyer is really going to care about the cash flow that your business can generate. So that is. We look at the asset-based approach, but we're not going to spend as much time, and because we're not doing a business valuation in compliance with SSVS 1, we don't really need to spend a lot of time in this area. So let's move on before we get to our Q&A period. So you've done the valuation, you've engaged an exit planner. What's the next steps? So the first one is rather obvious, but it's incorporate the value of the business into your financial analysis. As we said before, for most folks, the value of their business is going to be the primary asset, in their exit plan. So, but more than likely, what happens if the valuation doesn't really end up where you thought it was going to be? Walter and I both have the experience when we start talking to business owners. It's almost a universal truth that most business owners believe that the value of their company is a lot higher than the number that we usually end up coming up with. So if that's the case here, use the valuation as your guide to increasing the value of your company. So the valuation will tell you what the drivers of that value are, and we can use that information in order to help improve you, especially if we have time to do so. So key takeaways as we begin to wrap today's presentation: a proper exit plan can really help maximize the value, minimize the risk, and help you stay in control of not only just your business, but your overall assets. In step 2, a business valuation coupled with personal financial analysis is really the first step in the planning process, because we need to know what your assets are worth, we need to know what your plan is, what your goals are, where you are in life. And overcome your most difficult challenges with the help of an exit planning advisor. That's what we're here for. It's a service that can really help you transition to the next phase of your life. So before we get to the Q&A and before we get to the CPE questionnaire, we want to invite you to join us again in the next series in our 2017 webinar series, Unraveling the Complexity of Expatriate Taxation, How Employers Can Achieve Compliance and Promote Employee Satisfaction. So this is going to be given by GRF partner Troy Turner, who's an expert in this area. And as you can see, this is July 25th, 2017, so we invite you to join us. Great. Okay, so we're going to go to our Q&A period here in the remaining time that we have left. And so the first question we have, and Walter and I can both attempt to answer these questions. Walter, what do you think is the biggest impediment you see into business owners creating an exit plan?
Well, I think part of it is just not really thinking ahead as to the complexities involved with how they're going to exit their business. A lot of business owners are like the rest of us. They're very busy conducting their day-to-day lives, and I think there's you can start to think that the exit's going to take care of itself. You hear people say, well, they're just going to carry me out of my office one day. I guess that is an exit plan, but it's going to leave your spouse and employees in kind of a bad situation. So I think it's like anything else. And we see it a lot with estate planning. People don't like to deal with what they view as like the end of an important phase of their life, I think.
Yeah, that makes a lot.
And it's complicated. It's very complicated, and they don't know where to start. That's why I think using an exit planner makes it a lot easier for them.
Okay, great. The next question is there a point when it's really too late to implement an exit plan or a plan in general? What do you think about that?
You're never really too late to implement a plan. Your plan is going to be a lot simpler if you're trying to get out quickly, because you're not going to have time to really put in more complicated things like incentive compensation and things like that to help grow the value of the business. But you can do other things, like, for instance, if you have key employees, a simple thing to do is give them what's called a stay bonus. And what that means is basically if the business is sold, they receive a substantial bonus 6 months after that date if they're still with the company, and then they receive another substantial bonus after 12 months. So that's a great way if the value of your business is tied up with key employees and you really haven't been proactive with incentive compensation plans and things like that. That's kind of a way at the last minute to tie them to the company, which the buyer will really like, and usually the seller bears the cost of the stay bonus. But there's other things you can do, like just making sure you've cleaned up your HR policies, or you've cleaned up your accounting system, or you have a lawyer make sure that all your intellectual property is properly licensed, things like that. Okay. So there are, even at the last minute, there are things that need to be done, but obviously the more time you have, the better off you are in any planning process, and especially exit planning.
Okay. Well, I think we have about 2 minutes left, so we have time for one question. The one question that came through was, the cost of some of these services can seem a little bit daunting, perhaps, in some situations, the cost of a business valuation and the exit planning. So can you talk about the kind of the cost benefits briefly about creating an exit plan?
Yeah, we recommend is, as a first step, to do the business valuation and the coupled with the financial needs analysis. And if we do all that, it's probably going to be somewhere between $5,000 to $7,000. If we work with your money manager, the money manager may very well do the financial piece for free, and then we would only have to do the valuation, which would reduce the cost by a couple $1,000. But to me, that's definitely a good investment, because you're going to come away with, number one, you're going to know exactly where you stand. As a result of the valuation, you're going to know the challenges that we believe in a valuation context your company faces. And we'll also be able to identify, revenue drivers and things that are going to help you grow the value of that business. So, like I mentioned earlier, if you can bump your multiple by 1, that could be hundreds of thousands or millions of dollars in increased value. So, to me, the cost-benefit analysis is really, really, really strong. But I fully understand there's always a hesitance to spend money on something, but in this case, I think it's well worth it.
Okay. And one question slipped right in right under the time. So just we can try to briefly answer. Basically, Walter, we got a question that says, if what resources are available for if you are really small, developing an exit plan for a really small business, maybe 150,000 to 200,000 in revenue. Are there any resources that would be available in the time we have left?
I mean, our website has a lot of white papers and things like that that are really good. They could probably also go like to the Exit Planning Institute. I think they might make some of their materials available to the public, and also BEI, the Business Enterprise Institute, which has exit planning. They may make some of their materials available to the public.
Okay, great. Well, today, thank you so much for attending today's webinar. If you have additional questions, we have on the screen here ways that you can get in touch with us, both Walter and myself. We have our website there and our social media presence as well. And so again, we thank you so much for joining, and we look forward to seeing you in the next webinar in our series. So have a great rest of your day and have a great holiday weekend. Thanks, everyone.